Happy Wednesday, and welcome to another edition of Midweek Ponce Speaks. My name is Ponce Lemire, your favorite investment advisor. And for those that saw the episode last week, I touched on universal life. So I want to pick up right there. It's a very great strategy to add to your overall portfolio. But today I'm really excited because I actually just had a meeting with a lady who set up an indexed universal life policy for her 3-year-old son. And why is that exciting? And why does that make sense? So we went through the numbers, and the way that we structured this policy is this. First of all, a kid like that, the best time to really put together this strategy with universal life is for a child. 3 years old, 4 years old, 5 years old. Why? Because they're young, they don't smoke cigarettes, they don't have any heart issues, any lung issues, they don't, in some cases, I guess they could have asthma, but in general, they're healthy. They don't have any felonies, they don't have any DUIs or anything like that, which means underwriting is easy. It's easy to get them through the underwriting process. The second reason is because the cost of insurance is very low for children. The younger we are, the healthier we are, the lower the cost of insurance. So at the end of the day, like I said, the index universal life strategy is all about life insurance. At the end of the day, it's still life insurance. If somebody passes, the family gets the death benefit. But watch how the cash accumulation grows. So the way it works, what this mother has been able to do is financially set her son up for the future. Because of the cash accumulation aspect of Index Universal Life, she pays the premium every month or annually. She's actually going to be paying it annually. But as she pays that, in 20 years, this kid is going to have a nice amount of cash value built up in that policy, to the tune of about $20,000, meaning that if something were to transpire where they needed to pull that money out to pay for his college, they could pull that money out to maybe buy a home for him. Whatever the situation is, in 20 years, he'll have roughly $25,000 built up in that policy. So we fast forwarded it to the future, and in 40 years, by the time this kid's in his 40s, he'll have like $60,000 worth of cash value in that policy, and so on. We took it all the way out to the age of 64, and the kid's going to have over $200,000 worth of cash value built up in that policy that he can use, he can take out, do whatever it is that he wants to do. Now, of course, at the end of the day, God forbid, if he passes, there's still a death benefit. But why is it really special that this mom put this in place for this kid at 3? Because at the age of 30, 40, 50, well, he may or may not be able to get a $250,000 life insurance policy. Why? Maybe his health isn't the best. Maybe he can't health qualify at that point. Maybe at that point he's smoking cigarettes, tobacco. Maybe at that point he's got a horrible driving record. Well, now he's got that $250,000 policy that dear old mom took out for him at 3 years old. And now he's got a $250,000 policy that, now he's an adult. He's got children. He's got a family. He owns a home. Okay, he's got debt. So he needs $250,000 that if he passes can be given to his family, right? So it was the forethought of his mom to do that for him at 3 years old. Now, if he doesn't pass away, again, you've got this $250,000 policy, but by that time, he's got 90, 100, whatever the numbers are. It depends on how much the monthly premium is and that. But the point is, he's got a substantial amount of cash value built up in that policy over those 30, 40 years. So now, let's just say, for example, the policy's worth, $250,000. But he's got, we'll just say, $100,000 worth of cash value built up. Now at the age of 50, 60, 40, whatever that number is, that age is, he can take that $100,000 out as a loan to himself. Use that $100,000 for whatever he wants to use it for, right? Now he has to understand though, if you take the 100,000, then the family will get the difference to the 250 if he passes away. So what would the family get? $150,000. But that's fine. That's the point of this strategy. You walk, the insured walks away with 100 grand to do whatever they want to do while they're living, and then they pass away, the family's still going to get $150,000 in life insurance, tax-free. Okay? So it's just a phenomenal strategy, and I was really excited, and it really makes sense again for, to do that with a child, 3, 4, 5, even up to 10, maybe even 15 years old. When they're young, they're healthy, they haven't gotten into any legal issues, we can get them through the underwriting, the cost of insurance is low, and there's a long time horizon to let that cash value build up, okay? And we're guaranteeing their insurable interest in the future, or I should say their insurability in the future, that they can have a $250,000 policy no matter what that current health situation is, okay? So just wanted to talk a little bit about that. I was really excited the way it worked, the way the numbers worked. And everybody's numbers are going to be different. It depends on the premium and how much you're putting in and that sort of thing. But the concept works the same. All right. So again, I like to keep these short and sweet. But if you have any questions or you want to get more information about universal life and how that works, Index Universal Life, most of you know me. You could just give me a call. Send me a message on Messenger, send me an inbox, say, hey, Ponce, I'd like to talk with you more about, how that strategy can work for me. And we can go through it. Okay. So again, that's another edition of Midweek Ponce Speaks. I appreciate you guys tuning in, supporting, liking the videos, and I'll see you next time.